Hello guys, welcome back to our YouTube channel. So guys, in today I have another bang for you guys. We have analysis of transaction, in which we know it as accounting equation. So guys, what we are going to take a look at its accounting equation, and first we need to know what is accounting equation. Accounting equation is nothing else but assets are equals to accounting equation. It's nothing else but assets are equals to our owner's equity plus liabilities, as well as we have assets. Under assets we have fixed assets as well as current assets. Under fixed asset we have land and building, vehicle, equipment, and then under current asset we have bank, trading stock, debtors control, PT cash, and cash flow. And then what we need to know is that assets are increasing under the debit side while they decrease under the credit side. And then we have owner's equity. Owner's equity are the interest of the owner in the business, whereby under the credit side we'll have incomes, and then under the debit side we'll have expenses. And then our owner's equity will increase under the credit side because of all the incomes that we have, and decrease under the debit side because of all the expenses that we have. So let's take a look of all the incomes that we have. The first income that we are going to have, it's regarded as capital, and then drawing, it's going to be our our expense. Drawings are going to be our expense, and then capital will always be our income, because of is the money coming in the business. And then we are going to have nominal account. And then the first we are going to have incomes illustrated as sales. If ever we are selling goods and services known as our trading stock, then we are generating income in the business. And then rent income, money received from our tenant, then it's our incomes in the business, and they will increase our owner's equity. Current income known as services rendered, as well as interest income, and many more accounts such as discount received, and then discount received, as well as many more accounts. And then they will increase our owner's equity. Our owner's equity, it will be it will be increased by these incomes. And then we are going to have expenses such as cost of sales, and then rent expense, stationery, telephone, wages, salaries, water and electricity, interest expense, as well as material cost, and many more other expenses in the business. Why? Because of they become expenses because of they are going to decrease our owner's equity, the interest of the business. Why? Because of we are going to take out money to pay goods and services, or money to pay wages, or money to pay salaries. So they will be referred as expenses, and they need to be illustrated by a negative sign under our owner's equity. And then guys, we have our liabilities. Liabilities normally are referred as as debts of the business, whereby liabilities will increase under the credit side and decrease under the debit side. Whenever we accumulate debts, then our owner's equity will be affected under the credit side, and whenever we pay off our debts, then our liabilities will be affected under the debit side. And then some of the examples for our liabilities will be loan. And then loan, it's a liability, and it's compulsory that we settle our liability, as well as mortgage bonds. And then current liabilities, that most of the time that we know it's creditors control, because of we bought goods and services on credit, then we have a liability. And then whenever we pay off our liabilities, they will be affected under the debit side. So guys, and it's very important to know all your accounts, to be able to classify them. You need to be able to say vehicle, equipment, bank, trading stock, debtors control, PT cash, cash flows. They are part of of assets, and all assets increase under the debit side, decrease under the what, the credit side. Same thing when it comes to owner's equity. You need to know at least few of the accounts that are part of income, such as sales, rent income, current income, interest income, and then other accounts for expenses such as cost of sales, rent expense, stationery, telephone, wages, salaries, water and electricity, interest expense, and material cost. And then they form your owner's equity. While owner's equity is divided into two. Under the credit side we have what? Incomes. While under the debit side we are going to have what you call expenses. And then under the credit side, our expenses will be illustrated by a positive sign, and then our expenses will be illustrated by a negative sign. And then we go to our liabilities, and then the most important account, it will be creditors control, as well as loan, as well as mortgage bond, as well as SARS. And then SARS, it's regarded as our what? Our liability. If it's what? It's payable to SARS, and then it's going to be our liability, and all our liabilities will increase under the credit side, decrease under our debit side. So guys, and it's very important, guys, to have this instrument and know it by heart. This instrument, guys, it's going to help you a lot. So if currently you don't have it, make sure that you take a screenshot or you pause the video, you write it down, and then you save it. You put it under the what? The save place, because of this is really important for you guys in accounting. Thank you so much. So guys, and let's get straight to the point, whereby we are going to discuss our analysis of transactions, and then we have our answer sheet. And then guys, in question 1, and then this question paper was a common test for March 2022, and then it was question 1, and then it was 31 marks for 28 minutes. So guys, let's get to the point. Analysis of transactions. Analysis of transactions. You are provided with information relating to Mac Traders, a business owned by Sabelo Phakathi for the month of Feb 2020. So this business is owned by Sabelo, and the information that is given here it's related to Mac Traders. So Sabelo Phakathi is the owner of the business. Thank you so much. And then required. Analyze the following transactions according to columns provided. Assume that the bank balance is favorable at all times. So guys, in this information is very important, guys. We need to know if our bank balance, is it favorable? Whenever they say favorable, they mean what? It's positive, meaning there is money inside the bank account. Then if it's positive, then we know that our bank is classified as an what? As an asset. And then if the bank is unfavorable, then the bank will be what? Shown by a negative sign, meaning that our bank will be a liability, meaning our bank is under bank overdraft. You call it bank overdraft, so it's unfavorable. So right now it's very important, guys, before writing, make sure that you have the information if your bank is favorable or unfavorable. So in this case, they said assume that the bank balance is favorable at all times, meaning now our bank balance will only be based on the what? On the positive side. Will be based on the positive side and classified as an asset. And we know that all assets increase on our debit side, decrease under our credit side. So we have man, and then this will be the example that was given to us, and then we can quickly do this example. It says that bought stationery on account from Shukela Traders 500. So whenever they buy something on account, it means that they bought this thing on what? On credit. So stationery was bought on what? On credit. So what we need to do normally whenever I teach my learners, I will always say to them they need to have two accounts. Why do we need two accounts? Because of our answer sheet, it must be what? Account debited and then account credited. One account must be debited while another account must be what? Must be credited. So let's just quickly do this example. So what did we buy? We bought stationery. So now we need to have a what? We need to have a ledger account for stationery. This is what? It's stationery. This is stationery. And then we bought stationery for cash, or we bought stationery on credit. So it was written that the stationery was bought on account, and anything that was bought on account, it's bought on what? On credit, meaning we need to have what? Creditors control. Then we are going to have what? Creditors control, because of we bought stationery on what? On credit. And then now guys, from this step now guys, we need to be able to classify our accounts. So stationery is classified as what? Stationery is classified as owner's what? Equity. And we know that owner's equity under the credit side must be positive, and then owner's equity under the debit side must be what? Negative. But what we know that stationery it's an expense, meaning it will increase under the debit side, and then stationery it will decrease under the credit side. So in this video, I'm not going to write signs for stationery for an individual account, but what I'm going to write, the main focus will be our owner's equity, effects of owner's what? Equity in general. So under the credit side it will be a positive sign, under the debit side it will be a negative sign. And then let's go to a creditors control. Creditors control is classified as what? Creditors control is classified as a liability, and then all liabilities will increase under the credit side, decrease under the what? The debit side. The more debts we accumulate, or whenever we buy on credit, our creditors control will have to increase under the credit side, and then whenever we pay off, then it will be affected under the debit side. So in this statement, we are not paying anything, but we decided to buy stationery. So we are buying stationery on credit. So what is going to happen with our debts, with our liabilities? Are they going to increase or decrease? Yes, you are correct. Our liabilities will do what? Will increase, and then will increase with how much? 500 rand. On which side? On the credit side, meaning we are accumulating more debts. But what did we buy on credit? We bought stationery, and then we are going to write stationery. Stationery was bought on what? On credit. And then one account it's credited automatically. You can use what you call its double entry principle. It's what? Double entry principle. So we can use what you call double entry principle. One account, if it's credited, then another account must be what? Must be debited. So one account is credited, which is creditors control, meaning our stationery must be what? Must be debited, 500. And then we bought this stationery on what? On credit. Then it's creditors what? Control. We did not buy for cash. And then this is how basically we do it. And then account debited, it's going to be what? Stationery, because of we recorded stationery under the debit side. Then we are going to write there that stationery is the account that is what? Is debited. And then as they did in our example there, that stationery is debited, and then account that is credited, it's what? It's creditors control, because of we recorded under the credit side. And then it's what? It's creditors control, and then we are crediting it with how much amount? And then it was 500. We bought for how much? For 500, and then we put 500. So now we need to be able to what? To record under our accounting equation. So under our accounting equation, we are going to have assets, owner's equity, as well as liabilities. And then now we need to record using the what? The signs. And then we start. Stationery is classified as what? As assets, owner's equity, or a liability. Then you can come to your small workings there. Stationery is classified as what? As owner's equity. And then what is going to be how is owner's equity going to be affected? Owner's equity will be affected on the what? On the negative side. On the what? On the negative side, because of stationery was recorded on which side? On the negative side. And then we are going to come and put our what? Our negative sign. This is our negative sign. And then we move on. Creditors control is classified as what? Creditors control is classified as a liability. How are liabilities going to be affected? Positive or negative? Liabilities will be affected positively because of we bought stationery on credit and we recorded under the positive side, and then we are going to go under liabilities and put our positive side, while we don't have an entry for owners for assets. So assets will be so simple. So guys, and since now we are quite sure that we are doing things in a correct way, so we might as well start with our given transactions and be able to fill up our general ledger as well as the amount as well as our accounting equation. So guys, let's get straight to business. Transactions. First transaction, our supplier Maisela Traders charged the business an interest of 12% per annum on an overdue account of 12,000 for 2 months. Provide for the outstanding interest. Guys, and whenever you come to this kind of transactions, you need to read with understanding. So what is happening in this transaction? They are telling us that our supplier, the keyword is our supplier Maisel, our supplier Maisel charged the business an interest of 12% on an overdue account of 12,000 for 2 months. Provide for outstanding interest, meaning that, guys, we can be charged interest because of late payments by our suppliers, in which our suppliers are known as our creditors, meaning we bought goods and services on credit and we did not pay on time. So now they charged us a 12% interest. So now we need to provide the outstanding interest. So guys, and let's start calculating the interest first. So now interest is rated at 12%. So we are owing how much? 12,000. Then we are going to write first 12,000 is the amount that we owe, multiply by 12 over 100, which is the rate of the interest per annum. Per annum, meaning it's for 12 months period. But it was charged for how many months? For only 2 months. Then we are going to multiply by 2 months over how many months? Over 12 months. So basically this is how we are going to calculate our interest. 12,000 multiplied by the rate of the percentage of the interest multiplied by the months we are charged for, and then how much are we going to have for interest. So it's going to be 12,000 multiplied by 12 divided by 100 multiplied by 2 divided by 12, and then we need to pay extra 240 to our creditors, meaning they are charging us 240. And then now, guys, since we were able to calculate the interest that is due, then we can start with our double entry principle. Can I just remove this for now? We can start with our double entry principle. So guys, they are charging us an interest. Then we are going to write it's interest expense, or interest on overdue account. And then who is charging us an interest? The person that is charging us an interest, it's our creditors, our suppliers. Then they are referred as our creditors, meaning we are going to have creditors control, meaning now we are accumulating more liabilities on top of the 12,000 that we are owing them. they are now charging us an extra 240, meaning we are accumulating more what liabilities. So now guys, and we need to be able to classify these two accounts. So guys, we need to be able to classify these two accounts. So interest expense is classified as what? Interest expense is classified as what? As owner's equity. And we said that, can I just change the color of my pen here so that we all of us we can understand and we can be able to see clearly what are we doing. So interest expense is classified as what? As owner's equity. And we said that all owners' equities will increase under the credit side and they will decrease under the debit side because of they serve the interest of what? Of partners. Incomes will be illustrated by the positive side, while expenses will be illustrated by what? By the negative side. And then under the debit side, it will be expenses. Under the what? The credit side, it will be incomes. And then creditors control. Creditors control is classified as an what? As a liability. And then all liabilities are increasing under the credit side and then decreasing under the what? The debit side. So more debts that you accumulate, they will have to increase under the credit side, and whenever we pay, we'll pay under the what? The debit side. Then our debts will do what? They will decrease. And then guys, same thing. So now let's start. If now our suppliers, our creditors, they are charging us an extra, in which it's what? It's an interest on overdue because of we are not paying on time. They are charging us 240. Our liabilities, are they going to increase or decrease? Our liabilities will do what? Will increase because of now we are owing extra 240. Then we'll have to what? To write down our extra to what? 240 as what? It's an interest. Interest on what? On overdue account. Overdue account. It's an interest on overdue account. And then double entry principle. And then now guys, and we can do what we call double entry principle. Double entry principle. One account must be credited while another account must be what? Must be debited. And guys, when it comes to reality, that 240 is going to be an expense to us because of it's an extra interest charged to us. Then it's going to be expense. So in reality, automatically it's going to affect our owner's equity in a what? In a negative manner because of now money has to come out of the what? Of the business. But if you can't understand individual accounts, you can use double entry principle. If ever you can be able to master one account, then the following account becomes simpler for you. So one account is credited and then another account must be what? Must be debited. And then we record 240. And then it was for what? This interest, it was for creditors control. And then now we can go and use or utilize our what? Our answer sheet. Now we can use our what? Our answer sheet. Account that is debited, it's what? It's interest expense. It's debited. We recorded interest expense under the debit side. And then now we have to what? To write it. Then it's what? Interest on overdue account or what? Interest expense. While account credited will be what? Will be about our creditors control. Then account credited, it's going to be what? Creditors control. And then with how much are we using? We are using how much? 240. So 240 will be debited and also what? Credited. And then now we can complete our accounting equation. So interest expense is classified as an what? As an asset, owner's equity, or a liability. Interest expense is classified as a what? As an owner's equity. And how will the interest expense affect our owner's equity? Positive or negative? It will affect our owner's equity in a what? In a negative way. Then we need to go under owner's equity and show the what? The negative side. And then we continue. We go to our creditors control. Is creditors control classified as an asset, owner's equity, or a liability? Creditors control is classified as what? As a liability. And how is it going to affect our liability? Positive or negative? It's going to be affected in a what? In a positive way, because of they have charged us extra 240. Then we have to go to our what? Liabilities and show the positive sign. Plus 240. And then assets are not affected at all. So guys, and please make sure that you understand this and you are willing to study this. This thing is very simple and straightforward. So guys, and now let's go to transaction number 2. So guys, let's go to transaction number 2. It says goods sold on credit. Goods sold on what? On credit. We are looking for important keys. So we sold goods on credit. What is goods? Goods are known as what? As trading stock. So goods in accounting are known as what? Trading stock. Meaning we sold our trading stock on what? On credit to Angel Shabangu for 6,000. It's a selling price. They gave us a selling price of 6,000, and then the markup percentage on cost is 50%. Make 2 entries. So guys, we need to make 2 entries. So guys, little bit of theory, little bit of understanding. So guys, whenever we sell goods and services, it doesn't matter cash or credit, we need to have at least 4 accounts. We need to have at least 4 ledger accounts. Then we are going to have our 4 ledger accounts. This will be our first ledger, and then our second ledger. It will be a double entry principle, followed by another ledger, T ledger account, and then the last T ledger account. Because of we are selling goods and services, it doesn't matter. For example, if we are selling goods and services for cash, then we are going to have bank, because of the money has to come to our bank account, and then that money that comes to our bank account, it was generated by what? It was generated by sales. Do you understand? And then what are we selling? We are selling trading stock. We are selling trading stock. But this trading stock, it's sold using what? It's sold using its cost of sales. So basically that's why we need 4 accounts. So we are going to have bank and sales because of we sold for cash. So this is basically what you are going to have, and then you start classifying your accounts. But in this transaction, we did not sell for cash, but we sold on what? On credit. Then we need to write what? Creditors debtors what? Control, because if we sold our goods and services on what? On credit to our debtors. Meaning whenever we sell goods and services, we are going to accumulate what you call debtors. Then we need to have what? Debtors control. And then this debtors control, it was generated by what? By the sales that were what? By goods and services that were sold on credit. But what did we sell on credit? We sold our trading stock. And trading stock needs to leave the business using what? Using its cost of what? Of sales. And then we start classifying the accounts. This is what basically we needed. So guys, in selling price, it will have to go with sales. And then we start now. First, let's start classifying the accounts. Debtors control is classified as what? As an asset. Then it's classified as an asset. All assets will have to increase under our debit side. All assets will have to increase under the debit side, decrease under our credit side. Sales are classified as what? Sales are classified as owner's equity. And then all owner's equity incomes will be under the credit side, while expenses will be under the debit side. And then we come. Trading stock is classified as what? trading stock is classified as an asset, and then all assets increase under the debit side, decrease under the what? The credit side. And then cost of sales is classified as what? Same thing as what? As owner's equity, and then all incomes will be under the credit side, all expenses will be under the what? The debit side. That's it. And then I might just show that we have debit as also credit. That's it, guys, and this is what we only need. So now let's record our information. We need to record our information. So guys, basically, if you can be able to understand one account between these two, then you are done. Which account is debited and which account is credited? Let's start here. If we sell our goods and services on credit to our debtors, will our debtors control increase or decrease? Our debtors control will increase. It will increase. With how much? With 6,000, because of now this particular a person, which is Angel Shabang, he's owing the business how much? 6,000. Then we need to have what? 6,000. He's owing the business 6,000. This is the what? The selling price. And then it was for what? It was for sales. It was for sales that were bought on what? On credit. It was for what? For sales that were bought on what? On credit, which is DJ the reference. And then we go to sales. One account is debited, meaning another account in the sales must be what? Must be credited. How much? 6,000. And then these sales were bought on what? They were bought on credit. We sold these sales on what? On credit. Then it's going to be what? Debtors control, because we sold on what? On credit. One account is debited while another account is what? Is credited. So we might as well go and record this information. Let's go. And then account debited, how much is it? Account debited, it will be what? Debtors control, because of it's what? It's debited. And then we are going to write debtors control. And then account credited, it's going to be what? It's going to be sales, because of we have credited the what? The sales. And then we write sales. And then how much amount it's going to be used for only these two accounts? Then we are going to use how much? 6,000, because of the selling price was 6,000. And then now we may start with our accounting equation. Debtors control, is classified as what? Asset, owner's equity, or liability? It's classified as an asset. Plus or minus? We recorded under the positive sign. Then we go to asset, and then we are going to write what? The positive sign. And then now we go to sales. Sales are classified as what? Assets, owner's equity, or a liability. Then they are classified as what? As owner's equity. Plus or minus? We recorded under the positive sign. Then we are going to write the positive sign. Plus. And then we did not say anything about liabilities. And then we put what? No entry, which is 0. We need to show this, guys, and it's very important to show this 0. It says it means that it's no entry. And then let's continue, guys. Following accounts: trading stock and cost of sales. So now basically this thing happens in the business. So guys, if we sell our trading stock, is our trading stock account or our trading stock going to increase or decrease? Our trading stock is going to decrease, because of the trading stock is leaving the business, meaning it's going to be what? It's going to decrease. But if we are buying more trading stock, then our trading stock will increase. But if we are selling, then our trading stock will have to do what? Will have to decrease. So now we sold our goods and services, we sold our trading stock. So now we need to show that our trading stock is going to what? To decrease on this side. And then they gave us the markup percentage. We can't write 6,000. 6,000 is the selling price, but we want the original cost price of what? Of trading stock. Then we'll have to write what? Cost of sales. It's cost of sales. Then we'll have to write cost of sales. Can I just do this so that we can have enough space. Then we'll have to have what? Cost of sales, because of our goods and services are going to decrease. Cost of sales. But how are we going to be able to calculate the cost of sales? So cost of sales, we were given the markup, the selling price. What we have, it's the 6,000. This is what we have. So we are going to use what we have in order to calculate what we don't have. So 6,000, it's what we have, and then it's going to be multiplied by what are we looking for? We are looking for cost of sales. So normally I always teach my learners that whenever you get to this type of information, you need to say that cost of price or cost of sales, it will always be 100%, while sales will always be what? Our 100% plus the markup percentage. So the markup percentage is 50%, meaning there will have to be more than our cost of price. Then it's going to be 150%. So what we have right now, we have only 150%, which is equals to how much? 6,000, which is equals to 6,000, and then 6,000 then our 6,000 multiplied by what we are looking for. What are we looking for? We are looking for a cost price, which is 100% divided by the what? By the percentage that we have, which is what? 150. Because of this 6,000, it's equals to what? 150, and then divided by 150, and then equals to how much? What we have multiplied by what we don't have divided by what we have. So we are going to say 6,000 multiplied by 100 divided by 150, and then equals to how much? 4,000, meaning our cost of sales must always be less than our what? Our selling price. Cost of sales must be less than our selling price. And then how much is our cost of sales? It's 4,000. And then one account is what? Is credited, meaning another account must be what? Debited. And then we are going to debit our cost of sales, 4,000, and then as what? Trading stock, as trading stock. So now guys, we can record our information. So now we need to go and record underneath there. So we are going to start. So we are going to do what? We are going to start. Trading stock, it's what? It's credited, and then cost of sales is what? Is debited. So account that is debited is cost of sales, and then we are going to write account that is debited is cost of sales, and then account that is credited is what? Trading stock. Trading stock. And then how much is the amount for these two accounts? It's 4,000 and 4,000 as our cost price, and then we are going to write 4,000. And then now we need to what? To be able to classify our accounts and show the what? The signs, the given signs. So let's start now. Cost of sales is classified as what? As an asset, owner's equity, or a liability. It's classified as an what? Owner's equity. And how will cost of sales affect our owner's equity? Will it be positive or negative? It will be negative because of we recorded under the what? The negative side. And then we are going to go to our owner's equity and write minus the negative side. And then we go for trading stock. Trading stock is classified as what? Asset, owner's equity, or a liability. Our trading stock is classified as an asset. And then how will our asset be affected? Positive or negative? They will be affected in the negative side. Then we have to go to assets and write what? Negative. And then we did not say anything about liabilities. So guys, this is how we do it. So guys, please redo it. Whenever you sell goods and services, then you need to have at least 4 accounts. Please make sure. Let's go to information number 3, similar to this one, and then you will see. So guys, our information 3, it says the following: the owner took merchandise for his personal use, 800. So guys, the owner of the business took what? Merchandise. What is merchandise? In accounting, it's trading stock. So now we are not selling our trading stock, but the owner decided to take what? Our trading stock in the business. For what? For his personal use. So whenever we see the word personal use in the business, we need to think of what? Drawings. So it's drawings. It's going to become an expense for us in the business because of now the owner is taking what? Trading stock in the business. And we need to also open our what? Our 2 accounts. And then what did the owner take? The owner took trading stock. The owner took what? Trading stock. And then for what? For personal use. And personal use is known as what? Is known as drawings. And then now we can start classifying our accounts. Trading stock is classified as an what? As an asset. Trading stock is classified as an asset, and all assets are positive under the debit side, and then they are all negative under the credit side. Drawings are classified as what? As owner's equity. On all owner's equity are positive under the credit side, and they are what? Negative under the what? The debit side. So this is basically what we need to know. This is what basically we need to know. And then we start. If the owner takes trading stock in the business, how is it going to affect our trading stock? Is it going to be plus or minus? Because of the owner is taking trading stock in the business, then our trading stock will be affected with the what? A negative sign. And then with the what? With a negative sign. With a negative sign. And then in this case, guys, they did not tell about us about selling prices and cost of price, meaning this 800 is straightforward as what? As cost price. And then we are just going to write 800, and then this 800 had to leave the business because of drawings, because of personal use. And then one account is debited, one account is what? Is debited, meaning another account must be what? Must be credited. And then 800, and then it's for what? It's for trading stock, personal use, trading stock for merchandise. And then now we can record our information. Account that is debited, it's what? It's drawings. Then we're going to write drawings are debited, and then account that is credited, it's what? It's trading stock, trading stock. Now how much? 800. And then now drawings classified as what? Asset, owner's equity, or liability? As owner's equity. How are they going to affect our owner's equity? Negative way. And then we're going to write minus. And then now we go to trading stock. Trading stock is classified as what? Asset, owner's equity, or liability? As asset. And how is our trading stock affected? Positive or negative? In the negative way. And then it's minus. And then guys, we do not have any debts or liabilities, then it's no entry. Let's go to our 4th transaction, in which is very interesting. And then guys, let's go to our 4th transaction. The fixed deposit of 20,000 with Mhlanga Bank has matured. So guys, we have a fixed deposit. Keywords first. We have a fixed deposit of how much? Of 20,000 with Mahlangu Bank has matured. Meaning it has what? It has increased. It has increased. There is something there. We have invested our 20,000, then there is an increase there. So let's find out. The bank deposited into the business bank account 22,500 including interest. So guys, and this is basically a good thing. So guys, we deposited 20,000 and then we got 22,500 in return, meaning we can clearly see that there was an interest income there. There was interest income, known as interest on fixed deposit. So basically it's 22,500 minus the 20,000 that we have invested, and then the difference is how much? 2,500. So 2,500 it's our it's our interest on fixed deposit, meaning we made an income guys. So, and it was already deposited in our business bank account, and then the bank deposited into the business bank account, meaning guys, we need to have another two accounts. The money came in our in our bank account, then we have bank, and then that money that came into our bank account, it's it's interest on fixed deposit. Then we need to have interest on fixed deposit. We need to have interest on on fixed deposit, and then it's interest on fixed deposit. Now let's start classifying our accounts. Bank is classified as an Bank is classified as an Bank is classified as an asset. All assets will increase on the debit side, decrease on the credit side. Interest on fixed deposit is classified as as an owner's equity, and then all owner's equity will increase under the credit side, decrease under the debit side. And then we start. Whenever we get money, or whenever the money is deposited in our bank account, what is going to happen with our bank account? Will it increase or decrease? Our bank account will increase. By how much? Our bank account will increase. It will increase by how much? By 2,500. And then that 2,500 was was interest on fixed deposit. Was interest on on fixed deposit. And I just write it here. It was our interest on fixed deposit. And then one account is debited, another account must be must be credited. And then our interest on fixed deposit must be credited with how much? 2,500. And then we need to say it went to our bank account. And then guys, we did only not receive. So guys, we did not only receive interest on fixed deposit, but they said that 22,500 including interest was was deposited into our bank account. So interest of how much? Of 2,500. So we were able to manage to record interest on on fixed deposit, and then the bank will be debited by interest on fixed deposit, and then one account is debited, and then another account must be must be credited. And then guys, we also need to show that again under bank account. We also need to show again guys that also in our bank account we received how much? We received 20,000, and this 20,000 was was a fixed deposit. Was a was a fixed deposit. And then one account is credited, meaning another account must be must be debited. And then which account will be will it be? And then which account will it be? And then that account will be will be a fixed deposit. And then it must be it must be credited with how much? 20,000. And then it's bank. The money went to the bank. And then guys, let's classify our accounts. And then bank, as we know that bank is classified as an asset, and it will increase under the debit side, decrease under the credit side. And also we need to classify our fixed deposit. Our fixed deposit is also classified as an asset. Let me change my color here so that we can all see and be clear. So fixed deposit is classified as an asset, and all asset will increase under the debit side and decrease under the credit side. And then guys, so now we can be able to record our information. And then account debited, the first account to be debited will be our bank account. Then we're going to write it's bank account, and then followed by account credited. Account credited, it's our fixed interest on fixed deposit, guys. And because I don't have enough space, I'll just write interest on fixed deposit. And then now let's put the signs. And then this bank is classified as as an asset, plus or minus plus. How much is the amount first? It's 2,500. And then the bank is classified as an asset, and then it's plus. So our assets will be will be positive. And then interest on fixed deposit is classified as as an owner's equity. And then how is it going to affect our owner's equity? In a positive way. Then we're going to show the positive side, while liabilities, it's no entry. And then we move to the two last accounts for 20,000, because of 2,500 plus 20,000 equals to how much? Equals to 22,500, as they said, including interest. And then we start. We have bank. The first account to be credited is bank. And then account that is credited is going to be fixed deposit. And then we're going to write fixed deposit. And then how much is that? It's 20,000. And then now let's classify the accounts. Bank is classified as as an asset, plus or minus? It's plus. Then our assets are going to be affected by a positive sign. And then we go to to fixed deposit. Fixed deposit is classified as is classified as an asset. And then how are our assets going to be affected? They're going to be affected by a negative sign. And then we also have to show that under asset. And then we are going to write that /negative. So the first one asset will increase, while another asset will do will decrease. And then no entry for for owner's equity as well as liability. So guys, please make sure you rewind this video, make sure you understand this video, and make sure guys that you read your galaxy or your classification of accounts, and make sure that you understand. Please pause, take notes, and rewind me. If you don't understand, make sure that you rewind so that you do you understand. So guys, basically this is our accounting equation, and it's out of 31 marks, so meaning it's a lot. So please use this strategy, and then you will see once you get one account correct, one account debited, meaning the other account must be credited. We call it double entry principle. So guys, make sure you smash that like button. Make sure guys you smash that subscription button and that notification button, so that whenever I upload, you are notified. So guys, this is the bang.